Primary reason that a profitable business will have cash flow issues comes down to a timing difference between the cost you incur to generate revenue versus when your customers actually pay you. So this would be typically, like if you're selling inventory or you have a subscription service or a retail shop, you are getting paid right when the customer is buying the service product.
They wouldn't have it any other way. They're
So
not going to assume that they could pay for it later.
right. Like when you think about it, when you ride in an Uber, you don't complete the ride and then the Uber driver doesn't give you an invoice and say, hey, pay me 30 days later. Right?
Well, a taxi driver makes you pay at the end of the
That's
ride.
true. That's true.
But you're not leaving that cab unless you pay them.
Yeah, you're not getting out.
Yeah.
Exactly.
Check out the Cash Flow Show. We discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cash Flow Show. The Cash Flow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. With Nikole and OKR.
Hello and welcome to the Cash Flow Show. Today we're talking about getting paid. I am Scotty OKR, and with me today is Nikole Mackenzie. What up, Nix?
Hello, sir.
How you doing?
I'm good. I'm just getting over a cold. Well, actually more of like the flu.
I'm in the middle of one right now, too. Yours was bad. You want to tell our listeners a little bit about Vegas? You came to Vegas. We came for QuickBooks Connect, and you were in your room for 48 hours.
Yes, I know the inside of the Aria hotel room very, very well. First day of the conference, morning of, come down with a fever. So I was pretty much in my room by myself while you guys were all out having fun. It was, honestly, the sickness wasn't bad. It was just the FOMO of knowing that you guys were all like 100 meters away from me outside the walls. And I wasn't there. I feel you.
So today we're going to be talking about the FOMO of not getting paid and make sure that you are getting paid and you got more money in your account and you're not stuck in your hotel room. Last episode, we talked about COGS, cost of goods sold, gears in the car, knowing that your COGS is fundamental to being profitable and making money. What insights are you going to share with me today and our listeners?
Yeah, so last time we talked about COGS, and hopefully everyone learned how to calculate that more accurately. And so hopefully we've fixed your profitability problem, which is the fundamental starting point. And then so what can happen, Scott, is even though you're profitable, you can still have cash flow issues. So today we're going to be talking about getting paid.
That's like profitable on paper, but not really having the paper to show for it.
Exactly. Right. Exactly. And that's a question we get a lot from our clients is when I look at my profit and loss statement, it shows I have a profit. When I look at my bank account, there's nothing in it. What the hell is happening here?
We're talking about getting paid, and a lot of people are invoicing or I don't know, like what I'm trying to think of, because from my perspective and my mindset as an accounting firm owner and a professional services, we used to just spend so much time doing people's work, and then finally we get paid for it after. And then there was discussion about the bill, and we had to adjust the bill and we had to do things. So it was the way that we were invoicing clients, and we weren't invoicing them until we finished the work. And that was totally backwards, because then we're always playing catch up. We're always looking to get paid and ways that we can do it. So we had to change our mindset around that at our firm. I don't think we run into the same problem, but I think that's also might be what we touch on today. Am I onto something there?
Exactly. So the primary reason that a profitable business will have cash flow issues comes down to a timing difference between the cost you incur to generate revenue versus when your customers actually pay you. So this would be typically, like if you're selling inventory or you have a subscription service or a retail shop, you are getting paid right when the customer is buying the service product.
They wouldn't have it any other way. They're not going to assume that they could pay for it later.
Right. Like when you think about it, when you ride in an Uber, you don't complete the ride and then the Uber driver doesn't give you an invoice and say, hey, pay me 30 days later. Right.
Well, a taxi driver makes you pay at the end of the ride.
That's true.
But you're not leaving that cab unless you pay them.
Yeah, you're not getting out.
Yeah.
Exactly. And so when we think about businesses and the evolution of technology, the old way of getting paid was that you performed a service or you did something for a customer. And it wasn't necessarily, if you have a customer across town, you can't collect payment from them right away, right? Because they may have to send the invoice to their accounting department and it get processed. So think about the old way of getting paid. You do something, your bookkeeper would put together an invoice. They would mail it to your customer. Your customer's accountant, bookkeeper would then process the invoice, put it into accounts payable. Then it would need to get approved. Then a check would need to be cut. Then they would stuff that in an envelope and then they would mail it back to you. And then the check's in the mail. And then the other bookkeeper, okay, now they received the check and they have to go down to the bank and deposit it. And so that is why when you think about these buckets that you would see on your accounts receivable aging, 30, 60, 90 days, that's why you had so much time to do that. But think about now in 2023, there is absolutely no reason that you should be giving your customers that much time to pay you.
Yeah, it's a mindset. And we have the ability, we have the technology now to change all of that. A lot of businesses are stuck in that old, we write checks. That's what we do. That's our systems. But that stuff's going to die out over time, or you can change that.
Yes, I hope so. And so we're going to talk about the techniques and technology and ways that you can make sure that you are getting paid more timely from your customers. And then also talking about how that actually impacts your cash flow. So Scott, do you know how long it takes on average for businesses to be paid? And talking about businesses that are sending out invoices, not talking about like, a retail shop where customers are paying right there.
30 days.
It's actually 52 days that it takes on average.
52 days?
Yes.
That's almost 2 months.
That's almost 2 months. So think about that. So let me just, if you think about
half
that.
a quarter.
Yeah, half a quarter.
It takes half a quarter to get paid.
Yeah. And the issue is that you have to cover all your expenses to generate that revenue for 2 months before you get paid. So let me just give you an example of how this can get snowball out of hand. So let's say, Scott, that you're really good at making websites. And so your friends keep asking you to make websites more and more. So you're like, hey, you know what? I'm going to start a web development business. So it's just you. You've got a couple of friends who are customers. You do your first job and maybe you send out an invoice a month later after you do the work. And then you get paid another month. So it's been 60 days before your client pays you. Probably not that big of a deal because it's just you, right? Like you can probably go a couple months without getting paid and then you'll get on that monthly schedule of being paid. So again, not a big deal. It's just you. But let's say that you have
Well, how do you get out of the way? How do you fix that?
Well, now you look at not a big deal, right? Not a big deal. Now you have more demand. So you decide I'm going to hire an employee. So what do you want your employee's name to be?
Sam.
Okay. So you go out and hire Sam and Sam's really good. So you're going to pay Sam $10,000 a month, $120,000 salary. So first month on the job, Sam costs you $10,000. Now, Sam is going to generate $20,000 of revenue for you, which is awesome. That's a 50% gross profit margin, or what we talked about last episode. But let's say you don't get paid for 60 days. So month one, your cash outflow is $10,000. Your cash inflow for the $20,000 in revenue that you generated is $0. since you've hired that employee, your net cash outflow is $10,000.
That's the 10,000 you've paid them.
That's the 10,000 you pay them, and you've collected nothing. Okay.
Mm-hmm.
Month 2, you pay him. Sam's getting paid. He's getting paid right on every 2 weeks.
Oh, no. That's a she. I'm sorry.
Oh, she. Oh, I'm sorry.
Clarify. Sam for Samantha.
Okay.
Yeah.
Oh, I'm so sorry. I made an assumption. So Sam gets paid month 2. So she's got another $10,000. At this point, you have generated $40,000 worth of revenue, right? 20,000, 20,000. But you still haven't received anything from your customers yet. You've paid out $20,000.
But Sam's been killing it. She's been working so hard.
Yes. But what, okay. So my question is where, Scott, do you come up with the $20,000 so that you can pay Sam's salary until you collect from your customers?
Well, I better have had it in the bank already. And if I didn't, now I got to go get a loan just to pay my employee.
Exactly. And imagine if you have 20 employees, if you have 30 employees, how this problem can compound itself. And so if we look at month 3, okay, you finally collected your first 20,000.
It's been 52 days at this point.
It's been 52 days. You've paid out $30,000 in wages and you've only received 20,000. So you're still, by the 3rd month, you're still.
But that other one's in the mail, right? That other 20K is in the mail.
Exactly. Yeah. Exactly. But I'm just trying to illustrate what's happening here is it's a timing difference. And if you give your customers longer to pay you, or you wait until after you pay your employees, you're always going to be chasing revenue. If you're growing, you're always going to have cash flow issues because you have to fund that growth continually with more people, with more expenses. And so what we want to do is we actually want to flip that. We want to get paid from our customers before we pay our employees.
So how do we do that? This is depressing. Like I don't want to go into business now. This sounds like a struggle. We're always going to have cash flow issues.
If you think about over the years I've been doing this, even our clients that are the most successful go through times of challenges, of cash flow challenges, right?
I have. I've been very outspoken about that. It's tough. A lot of business owners too, they get excited about things and they start these grand projects or things and they spend a lot of money and then they get met with the reality of they got to get paid. And then they're afraid to ask people to get paid. They're afraid to ask the clients that are supposed to pay them. Like, because then I've seen this happen too. Clients get defensive. If they haven't paid you and they don't have the money to get paid, they get mad because you're asking them for the money. I've had that happen too before. It's a psychological mess sometimes too when it has to do with the money.
Well, I learned this lesson the hard way. So when I first started my business, I was working with a client that sold like eyeglass accessories, and they were like on the verge of going bankrupt. Looking back, at that time I was new. I just started. They were like my first client, and every week they needed to pay. They had inventory on the dock in China, and it was like, if we don't pay this vendor, then the business is going to go bankrupt because we can't get the inventory. And if we can't sell the inventory, we don't have revenue.
And we can't sell it.
It got to the point where they owed me $20,000 and they owed me $20,000 and I had just hired Ramona. So I was paying her and they ended up going bankrupt and they owed me 20 grand and I didn't get paid and it freaking sucked. And so from that moment on, I never, in very, very rare occasions, I have still one client that pays us after the fact, but he's been a long time, 7-year client and never not paid me. But all of our clients now pay us. Yeah, this is a true story.
You almost went out of business. Not your client. You almost did.
Yeah, it was just me and Ramona at that time. So luckily, if it was a situation where I had more employees and it was a bigger dollar amount, it could have been really impactful. But that's why you want to have control. You don't want to get in a situation where the customer might not pay you. And I can tell you from helping businesses with their accounts payable, what that is like from their side. Like when they're going through and they're choosing vendors, like they only have so much cash a lot of the time. And so if you are constantly on that accounts payable aging and you're not an important vendor, like I said, the vendors where they need inventory, like those are their number one vendors, you're going to consistently be pushed down to the bottom of the list. So you want your customers to be thinking of you, especially if you're like what we do, right? A service where it's recurring. You want them to think of you like employees where you don't miss payroll. And so we want our customers to think of us like that.
So that starts with setting the tone at the beginning of the relationship, especially with professional services, because like you said, it's a psychological thing and they only do what's expected of them to a large degree. And if you don't set the expectation that you're getting paid up front, then they're never going to change that. And like you said, you had a client for 7 years. If you tried to change that and have them pay up front, they may go look for somebody else. Even though it's been 7 years, they're just not used to that. It's an entire mindset shift. We had to do it, and it was a 2-year process for us to change all that over with everybody in our firm. We lost a lot of clients along the way, but everybody was paying for everything that they did after we finished the work. And at the point when I remember the point when I decided we were going to change that, and the conversation we had internally, it was difficult. It was like we had people prepay for stuff and post pay in the same year. So people were paying for 2 years at once during this transition, and it worked out great for cash flow and everything. But then I also didn't plan for the growth, and we hired people because we had double money coming in one year.
You had too much
overhired.
cash.
I had too much cash, overhired, and then the next year had to let 2 people go. And things have settled now, but our entire strategy, entire way of getting paid, and the way we price and the expectations we set are all different. But it's a process. And so if you are having trouble and you are going to change, we're going to give you some solutions. We're going to give you some tips and insights, but it's going to take time. It's going to require patience, and you're going to lose clients. You're going to lose things along the way too. But in the end, if you do things intentionally and you set out to make sure you're getting paid first, then you won't have the same problems that you may be having right now.
Yeah. There's a book, I haven't read it, but I've heard about it. I think it's called A Customer Funded Startup. And it's all about how can you have basically just how it sounds. But there was a woman in my EO community who has a really cool story. She started a cafe up in wine country. And in order to, when you first start a business up, a cafe, wine cafe, not a lot of money coming in initially, right? You need customers and you have expenses immediately. You have rent, you have people. And so what she did was she pre-sold a year's worth of, I think it was like every week you had a certain amount of like wine or food credit that you could use. Mm-hmm. And it was like insanely cheap for the value. But what she ended up doing was she ended up raising like $20,000 to fund the startup of her business. And then people would come in and they would bring friends, even though because they had the cheap deal, but their friends didn't, and their friends would pay full price. So that's a really good example of being creative with how can I get cash in the door right now so that I can get started and pay those future expenses.
And that's how it should be though, right? Like if you're creating a product that has value or creating a service or anything else, people should be paying for it, and we shouldn't have these cash flow problems.
Yeah, and a lot of people will say, I bill by the hour, so I don't know how much I'm
Oh yeah,
going
that's the
to
thing
charge.
too, is billing by the hour. Like that's not going to go away.
That's not going to go
billing.
away. There's a lot of business models where like we have clients that bill by the hour and they're making a ton of money. Like it's a little more stressful. You still have to deal with some issues after the fact. It's not for me. But what we want to do in those situations.
It's all after the fact with hourly billing.
Yes. But we can still, just because you're billing by the hour and you don't know how many hours you're going to spend until after you've done the services, does not mean that we can't be more in control of our cash. So some strategies so for example, like every once in a while, we will bill by the hour. Like if we just have no freaking clue how long something's going to take, we will pull that out of our toolbox. But what we'll do is we always take a deposit for half up front. Ooh. And then we get ACH authorization. And so what that means is we've got a pre-approved set of hours. So let's say we have 50 hours. They're paying us for 25 hours up front. When we've hit the 50-hour milestone, then we are automatically pulling that money from our client's bank account on that day. So the idea here is we have complete control over pulling that money from the client's bank account rather than sending them an invoice and then they're in control. They pay it whenever they want to pay it, if they even pay it. Because once the project is done, it's anytime we're doing a one-time project and it's not recurring work, our risk of not being paid by our customers is much, much higher than having a recurring relationship. So those especially you want to have a lot of control on.
That sounds great, because essentially what you're doing is you're still getting prepaid with that deposit, and then with the incremental billing and the pulls, you're operating just like any other business that would be getting paid up front.
Right. And so you can also do milestones. So let's say it's going to be a 6-month project. And so you could say at the beginning of every month, we're going to split it into 6 payments. At the beginning of every month, we're going to get paid. And again, you want to be in control of pulling that money out of their account. Here's what happens. So a lot of people say, well, I get paid up front. But what happens is they're waiting for payment from the customer, and the project gets delayed. But they don't want to delay the project because they've reserved the resources. So they kind of like start doing the project and then the customer doesn't pay them. And so that's why, again, I want to just clarify that when I say get paid, I mean, they've signed an authorization to either charge their credit card or you can pull money from their bank account. You're not waiting for them to send you an ACH, and you have control of that timing.
It's funny because during that process of us changing the way we build, we eliminated the need for anybody handling after the fact administrative AR. One of the people I had to let go was the front office person that was handling that, because we didn't have that role anymore. That role didn't really exist. We eliminated it. And there were other things that they were doing administratively too, but a lot of the bulk of it was just handling the after the fact stuff. So in a way, like it really simplified, it eliminated everything for AR. So I know I just stole your thunder on what you were going to say next, but this happened to me. Like, we didn't need accounts receivable. We didn't have the department anymore. So we eliminated a role, and look what that did to the cash flow scenario. Making much more money now because we're getting paid up front. We're getting paid for the work that we're doing beforehand, and we don't have to pay somebody to work through collections or to even pay a collection agency, which we've done before too, which is cutting into your cash flow. All of those things.
Yep. And it's funny because people get business owners that don't want to pay the 3% credit card fee, and they've got somebody who's spending half their time on collections, so they're paying a salary, which is probably equivalent or more than that 3%.
Collections is going to be much more than 3%.
Yes. Yeah. And not to mention that's assuming that you collect every dollar. Let's talk about the fact that you're going to have to write some off, and you're going to have to wait for it. So what's the value of having the cash in your bank account today versus 3 months from now, 2 months from now?
Yeah, for sure. That right there, if you were able to figure out a way to change your business to get paid up front, and I think that does eliminate a lot of the future cash flow issues.
Starting good habits.
Credit cards, like, it was an entire mindset shift too, because we still do mostly ACH. We do let our clients pay credit card, especially if they're new and we need a deposit up front, because we don't have time to build that trust over time when it comes to money. We need to get paid up front. So we do take credit card. But when I look at our, the number of transactions we have ACH versus credit card and the amount that we're paying for those credit card fees, it's astronomical compared to like ACH, which is at max like $5. And then the credit card, that 3%, it's tough to switch that up, let's just say, especially for somebody that's not used to doing it. My barber doesn't even take debit cards. I got to go in there with cash. So there's some people that still require cash. At least we're not requiring cash, but
well, that's a whole different topic of how do I avoid taxes. I think I don't think they're avoiding credit card fees. I think they're not reporting that to the government.
Okay.
And so, but you bring up a good point about credit card.
There's cash flow right there too.
But we will not be talking about that. Let's talk about when you would use ACH versus credit card. So to your point about getting paid up front. So anytime you need to get paid like quickly for something, credit card's a great option. So for example, when we do our discoveries, we charge $600, and it's like, we want to get that information from them as fast as possible, get the invoice paid so we can do our discovery. Once they sign on and become a client, then they're paying us recurring by ACH. But let me just talk about the pros and cons of each, because with ACH processors, and I'll get into some recommendations here in a minute, but with ACH, you really do need someone to manage that. So even though, okay, so we don't have somebody chasing AR anymore, which is great, the after the fact is eliminated, but you still need somebody who can resolve issues with clients. If the payment doesn't go through, the bank account doesn't work. You also have a lot of responsibility, because if you pull $10,000 out of your client's bank account and they didn't authorize that, like, you can get shut down. Your ACH vendor will shut you down. Your client will be pissed. You've eliminated all trust. Versus if you charge something on the credit card, it's pretty easy to reverse that, and there's not an immediate cash flow impact to your customer. And so
it's so hard to reverse ACHs. You basically can't. You have to write them a check, because it takes like 7 to 10 days to reverse an ACH.
Yeah, and I think about that as a business owner. If you all of a sudden had money coming out of your bank account that you were inspected, you'd be pissed. And like, you are not going to be allowing that anymore. And so we have to be very, very careful when we're dealing with ACH, and you need somebody smart who can understand how the payment processor works and also resolve any issues that might come up. Now, credit card, on the other hand, is great because it's a lot of times it's like self-serve. The client can go on there, they can manage their subscription, and there's just a lot less risks there in terms of accidentally charging it and then not being able to reverse it, and then having the immediate cash flow hit the customer's bank account. Now, the issue with credit cards is we already talked about, they're expensive, right? So you've got that 3% that you're paying. And then also what I've seen happen with credit cards before is customer will get pissed off about something and they can go and contest an entire year's worth of credit card charges. So let's say you've done $50,000 of work for a client. They get pissed at you about something. So they're, like, Scott, you. I'm going to go contest every single charge for every single month for the last year. And typically the credit card, all of a sudden you'll see $50,000 come out of your bank account. And typically the credit card will side with the person.
Has this happened to you?
It hasn't happened to me, but I've seen it happen.
Okay. Because I would say there's got to be something really wrong with either that customer or the relationship that would happen after an entire year. Something really bad had to have happened.
I've heard about this happening multiple times. So this is why I typically say, if it's a lot of small charges, like you're a SaaS company, you sell software and it's $100 a month, take credit cards. If you are a service business like ours, where you're charging, over $1,000 a month or $500 a month, it's worth it, I think, to use a ACH processor.
Yeah. So it sounds like any professional services, things like that. ACH.
And if anything that's recurring, if it's a one time, like you're like B2C and people are paying things one time, typically credit card, you want it to be fast and easy. If you have an ongoing relationship with them, larger dollar amounts, ACH.
So it sounds like where we're at is it starts in the beginning. It starts at the beginning of the relationship. It starts with, in order to get paid, you have to set the tone from the start. When you first get that customer, set the tone in the beginning.
Exactly. You just tell them that's how it is. We've never had any pushback, ever. As long as you just say, this is the way we do it, you don't give them an option.
Well, the only pushback you're going to have is they say no. Yeah. Like they don't become a customer. That's the only pushback you could ever have, but that's going to happen anyway. People are going to say no, even if you're not asking them to pay up front. You can set that tone in the beginning. It's worked. It's worked for us for the last 4 years or 3 years, however long it's been. Ever since we changed things over, we don't have cash flow problems. And we also don't have problems getting paid. And we have a line of customers out the door.
Yeah. So whoever's doing your sales or engagement letters, they need to be educated on how you guys do that. And they need to talk about that during the sales process. And they need to take ownership on that. I've also seen businesses where they have like there's one that had like a year-long training program, and they would give the salespeople bonuses or commissions if they pre-sold a package, if they collected 100% up front, 50% up front, or if it was monthly, depending on which one. The more they collected up front, the more of a bonus they would get. So
really?
So incentivizing your salespeople.
That's our commission structure right now. I changed it to be all cash basis. Whatever we get paid, they get 10% of that at the end of the month. As long as we're getting paid for it up front, they get that bonus. We want to talk about some tools, some things, some tech options that you can use to get paid, because that's our life. Like, as accountants that have been tech focused, we dove in head first, starting 2012 into all these different cloud apps. So for over 10 years, we've seen the progression of some of these apps. You and I were zero users early on, but a lot of tools sprung up from that cloud ecosystem. One that I use at our firm is Ignition. I used to be Practice Ignition, and that right there is why we get paid up front. That's why we have a clean sales process, and that's why we're able to collect up front, because of the systems that we have set up in Ignition. So that's a great one.
One of the things that's great about Ignition is the entire workflow is all integrated. So a lot of times we'll get clients that come to us and they'll have their books on QuickBooks and they'll be using Freshbooks, because Freshbooks has a really good invoicing and payment system. Yeah, it's awesome. But what's happening here is we're not integrating our accounting software with our payment system. And that is going to create all sorts of other issues, right? Because you don't actually know what customers owe you, because we're not tying back to your bank transactions. And so when we think about the entire workflow from when a customer receives a proposal to when you close out that invoice and reconcile it to your bank statement, that whole workflow we want to be integrated and automated. Proposal goes out and it has all the payment terms on it. Customer signs. After customer signs, they should be taken to a page where they add their ACH or credit card information. Invoices get automatically created based on the schedule into your accounting system. Invoices get automatically generated on the due date. Once they're generated, that triggers the payment processor to process the payment. And then that automatically gets matched to the actual collection in your bank system and closes out the invoice, and it closes out your accounts receivable. That whole thing. Getting paid. Like, think about how many things happen there that used to be so manual and after the fact that are now automated. That just gets done, that we take for granted.
Well, we don't take it for granted if it ever breaks, and if a connection is lost or things aren't reconciling, and that I definitely don't take it for granted, because I know how much it's doing and how much we used to have to do. Like, just keeping up with the records. Like, I used to have spreadsheets on spreadsheets with our ACH processor, nothing reconciled. So I'd have to go through and check off every single draft to make sure it added up to the amount that was drafted, because there was no other report anywhere. It was really cheap. We saved a ton of money on this ACH processor, but it was like, here's all these charges: 500, 700, 600, 600, 600, 500, 300, 300, 350. And it was just like hundreds of them sometimes. And I'd have to add them all up and match them up. And it was just a nightmare. And then Ignition solved all of that. And it creates these clearing accounts in the system, and it'll do that with Xero or QuickBooks. It's seamless. And I can click into it. I can click into it in Xero, and it opens up Ignition. And it's all connected. Ignition, I always say, or any payment collector, is the heart of your business. That's what pumps the blood in to everything else. And that's the cash. That's your cash. The heart of it is your cash flow. And you got to get that right. And you got to have a system that gets you paid, whether that's FreshBooks, whether that's Ignition, whether that's Anchor. There's lots of other ones out there. There's Go Cardless for ACH. Even within QuickBooks, they have a lot of payment solutions. I don't know. QuickBooks has a lot of different things, but yeah, that is the heart of your house, and making sure that you're getting paid up front. So yeah, this is
and I would say there's still accountability here, where we can't just put on the payment processor and think it's going to be 100% and work. There's other things on the back end happening, where if a credit card bounces, you need somebody that's looking at those notifications every day and going out and reaching out to the customer. You need to make sure somebody's job, on their job description, is you're responsible for money coming in the door, right? So some businesses where they can't get paid up front.
Let's talk about that, because that's happening to me now, working with these larger vendors with the accounting high stuff. Is they have payment terms. If you're working with large companies like Microsoft or Nike, they have strict policies, and they tell you up front, before you're going to be doing anything with them, this is a process. It's going to take a couple months just to get approved, and then it's going to be 30-day payment terms and this and that. And you got to just say yes. If you want to work with them, you have no choice, right?
Yes, they're going to push you around. And unfortunately, that's just part of working with some of these larger businesses because they're smart and they know how important cash is. So they're getting paid up front and they're pushing out their payments to vendors for as far out as they possibly
because
can. A
they
lot of
have
them
the
are 60
control.
days.
Remember, this is about control,
Control.
and they can control the narrative if they're the ones holding the keys to the kingdom. And if you want to work with them, you're going to have to succumb to the way that. So I don't believe in that. I don't think that's a good business model. But if that is your business model, then what can you do to make sure that you don't have cash flow issues?
Yeah, so these types of businesses, and we have several of them, that they work with big brands. And so the very first most important thing that you can do is negotiating payment terms as much as you can upfront. If you can negotiate milestones, some of my clients have been able to agree to dividing the projects into thirds. So they get 1/3 up front, 1/3 at a milestone, and then 1/3 at the end of the project. The key here, though, is when you're doing that based on milestones, is you better have your ops in place where like your team is producing, because if your project isn't delivered on time, you're not getting paid. And so it's like a whole system of making sure that things get delivered on the milestone so you can actually go out and upload an invoice. So the first most important thing, negotiating payment terms. The second thing would be making sure like as soon as you can invoice and you're able to upload your invoice to their portals. And we all know those portals are a freaking nightmare.
Worst.
The worst.
Coupa. I don't know if anybody's ever used Coupa. That's the worst.
Yep, Coupa, we use that for Gusto. And then God, QuickBooks, man, when I did some stuff for them, I swear to God, I probably spent 20 hours going back and forth with them. I was over it. I was like, I asked them, can I bill you my time for dealing with this? So yeah, unfortunately, that's just the name of the game when you're working with these large businesses. It's important to keep that and take that into consideration when you're pricing your margins, right? You have to impute some sort of cost of capital into that, because you're probably going to need to draw on a line of credit at some point, or you're going to need a lot of cash in reserves in order, again, because you're having to cover those expenses for 2 months before you get paid. We need to cover that gap between paying your people, your contractors, your employees versus when you get paid by the company. And
How do we bridge that gap?
So typically it's going to be cash reserves, it's going to be a line of credit, and then it's going to be working with an advisor who can help you with cash flow forecasting. So if you have we had a client that, man, he had this nice recurring revenue business that was profitable. And then he got together with a partner and he chased the big projects. So they were getting like $1 million project from Colombia, and Colombia, $1 million.
Yeah.
Okay. Let's say you're making 50% margin on that. You got to lay out $500,000 before you get paid that $1 million. How do you cover that? And man, they were just stressed out all the time. We ended up like parting ways with them because of just kind of like a show of a client. But my point is with that is you need somebody, an advisor on your side who can say, here's what we know is in the pipeline. Here's what we have that's actively being worked on. And here's our cash spread. Here's what's going to cost over this timeline. And looking forward, planning out when you're going to have cash shortages so you can plan for that several months out and say, hey, in 3 months, we are going to have $50,000 cash shortage. Where do we get that? Is that from a line of credit? Is that from investors? Is the business owner going to put money in? And you should be doing that on a regular cadence. It shouldn't be a surprise.
Yeah. Yeah. There should never be any surprises with that, but it's hard. And finding somebody that can even put together a forecast and keep up with it, like even quarterly.
Yeah, quarterly is good. And for businesses like that have recurring revenue, like our businesses, right? Like I never do a forecast because we're getting paid up front. So cash flow is never an issue for us. For these types of businesses, again, you have to have higher margins on this work because you have to take into account cost of capital, the cost of managing all of the cash, and the CFO that you're going to need to hire.
Let me tell you the value in a forecast if you are having cash flow issues. So we did one when I was having cash flow issues and fixed everything to the point where the cash flow forecast was underestimating our cash flow at a certain point. We don't even go back to it anymore because we fixed everything. Yeah. Maybe I should at a certain point if cash flow starts to get lower again, but it was all the details that you can do. You can adjust, salaries in there. It's just There's a lot of great tools for cash flow forecasting. We used Live Plan, and that's great for business owners to put their foot in and try to tinker with it. Or you can use somebody like Momentum Accounting, and they have tools and reporting tools that they use to give to you. I wouldn't recommend doing it yourself, actually, because a lot of businesses, if they don't have the experience in that, they can use something and then really screw it up and mispredict because they have an account going into the wrong place and it's not real. That cash flow that they're forecasting isn't actually, it may be like a pipe dream, and they may have actually misforecasted their sales and things like that.
Yeah,
So
I
you
find
need
a lot
somebody
of
that's a
the
little more
ones,
conservative.
a lot of the little apps that you connect to QuickBooks Online or Xero are, you really got to know what you're doing, because if you just take how it is out of the box, you're going to be way off. And then also you should be constantly improving and tracking your actual versus what you predicted. That way you can refine and continue. One more point I'm going to make out about these types of businesses where they do have to get paid after the fact is, in these situations, you are going to need an AR person or somebody who's accountable for collections. And the major problem I see is this task gets assigned to an admin or ops person, and it's one of 100 things that you need to get done. And they don't understand the importance of it. And so it gets pushed off. The business owner says, hey, Sam, we'll keep Sam now. Sam's an AR. Hey, Sam,
she moved
you're
to AR.
You're going to do collections.
Oh no, this
whatever.
Is Sam he now. This is the
Sam,
other Sam.
Yeah, this is a guy.
This is the he, yeah.
This is the he. And then they don't pay attention to it until there's no money in their bank account and they can't make payroll. And then they go to Sam. They're like, Sam, what the F? I told you to do collections. And Sam's like, well, I had all these other things to do, not realizing how important it is.
I had to send out birthday cards, Christmas cards.
Yeah, exactly. You told me to send out Christmas cards. If
I got glitter all over me now. Covered in glitter. Now you want me to collect money?
I sound like a stripper. So what we want to do is we want to make sure that person knows it's a very, very clear task that they need to do, and they're going to be evaluated on it. And we can even compensate them based on a small amount. Like, let's say for every dollar you collect before 30 days, you get 0.5% of it or something. It's nothing crazy, or a gift card or something. If you put incentives behind it, it's amazing what people will end up doing. And so you want that person to be calling the customers on a regular basis, making friends with the AP person, and just being very active in that process, not having it be an afterthought, 100 tasks.
Make friends with the AP person. That's a good one.
Yeah. Oh, yeah.
Because they're just trying to do their job too.
It works. I'm telling you, because they're paying bills.
They've got to choose. And if they know you, they see your name on that list, they associate that with their friendship with you. And all of a sudden you get bumped up on the list.
Mm-hmm.
Great strategy. And it's just like, for friendly people, it's easy to make friends and to like be friendly with them. You could send them an extra Christmas card, extra glitter in their card. What kind of business are we running that Sam is a male that is stripping and sending Christmas cards?
He's obviously not getting paid enough money.
Yeah, he's not getting paid enough. He's going to pay him up front. The other Sam's getting paid fine. She's already made $30K.
Yeah, she's getting paid.
And Sam's making 0.5% on his glitter bombs. All right, let's keep going.
Mike says I sound like a smoker right now.
Yeah.
Okay.
That's that cough.
Yeah.
So where are we at? You said review AR weekly and monitor DSO trends. What is DSO?
Oh, so DSO stands for Days Sales Outstanding, and it's a calculation you can do, and that's one thing we like to just put on our reports every month, is basically how long it takes customers to pay you.
Okay.
So if you're looking at this, let's say every month, and it was 14 days, now it's 30 days, now it's 60 days, it's a way for you to manage that as the business owners without getting into the detail of being like, what's happening here? And really drilling down into, was it because we have a new AR person and they're not collecting? You'll probably end up seeing it in your aging anyway, when you're looking at your AR aging. But we like to see it when we start working with a client for the first time or their prospect during our discovery. We'll look at DSO trends, because if we notice that their days to get paid are really high, then we can have a conversation about that with them immediately and try to figure out what's the problem here and how we can help them solve it.
And you can send them to episode 2 of the Cash Flow Show.
Exactly. Now I don't even have to do any work. I can just send them the I'll have to lecture
transcript. Dope. Getting paid starts with setting expectations, setting the tone from the beginning, changing your mindset around getting paid for any work, whether you bill hourly, project work, whatever it is. Get paid up front. Make sure that you are not having to deal with collections if you can help it. It makes work so much more fun when you don't have to worry about getting paid.
Oh my gosh. Yeah. And if you can look for opportunities for recurring revenue, I mean, that's the holy grail. There's a lot of ways you can be creative in your business. And if there's things your customers need repeatedly, how can you get them on some sort of subscription? And that way if you
look at what Disney did. Disney did it. If Disney could do it, you could do it.
Exactly. You're just like one of the most largest organizations in the world.
Yeah, but they didn't have a recurring model. Before Disney Plus, they didn't have a recurring model. And now they're just loading Disney Plus with more and more and more that they make it an insane amount of value for whatever you're paying on a recurring basis. So like you said, you had that client that was giving away an insane amount of value for what seemed like a very reasonable price. But if they're doing that at scale, then they're making bank. And they, maybe they have to deal with one or two people with, I want to take $200 off my credit card for the year. But other than that, you got your user base growing and all of these things. So if you could create a recurring model, everybody's doing it. Ferrari's doing it. Listen to Ron Baker. He wrote a new book, Time's Up. He's not even talking about time anymore. He's just talking about recurring models. We do it at our firms. I know everything for me. I'm just managing. Right at the top, I look at our recurring, and we just hit 90,000, our monthly recurring. I look at that, and I look at number of clients. Those are the things I look at. So we got about 103 clients at 90,000 recurring. I'm good.
Oh, I was going to say, so, the Tesla Cybertrucks are now coming out. So my friend, they took a deposit, I think of like $1,000. Tesla's always taking deposits.
Blake gave a deposit like 5 years ago or something.
Exactly. But think about how much money they raised in those deposits that helped them build the product, right?
They don't have cash flow issues either.
They're gauging interest, right, before they build it. And they're capitalizing some of the costs, right? They're collecting some of that money up front. So getting paid up front, looking for opportunities for recurring revenue, using payment processors, either ACH or credit card, making sure that your payment processes are integrated with your accounting software and your accounting process is really important. Otherwise, you're going to have yourself a big admin mess. And then if none of these are possible, make sure you have a really good AR process and person, and that person is accountable, compensated based on their performance.
Dope. This is very valuable. And I hope that you have learned something from this, our dear listeners of the Cash Flow Show. You have any calls to action for our listeners?
Yeah, if you need help improving your cash flow, feel free to reach out to us, or you can go to our website, momentumaccounting.com. On the contact page, you can book a call with us. If you need help with taxes, if you need help with taxes, call Scotty.
Yeah, if we're taking on new clients. We got a line out the door. We're not hiring right now. Everything's good.
Maximizing your profit margins right now.
Yes. Soon, more to come later. Stay tuned. I'm Scotty, OKR Scarano, and
I'm Nix.
Thanks, Nix. Thanks for joining us on the Cash Flow Show. Peace out, homies.
All right. See you next time. Bye.
Yeah. It's like you're drowning in cash flow issues. You run a business, but feel like it's running you. Customers won't pay, but you got bills due. It appears you won't have enough for payroll coming up soon. It seems like you running nowhere fast. You work hard, but never able to withdraw cash from the business. You get more customers, hire more employees, but still take home hardly anything. You feel like you're on a hamster wheel, frustrated cause the battle's always uphill. Even though you got a bookkeeper on your team, they send you reports, but you don't really know what they mean. Your CPA doesn't understand a thing about your business, at least that's how it seems. But if you want to get above water and grow, check out the Cash Flow Show. This is the Cash Flow Show, where we help the small business gain momentum and become profitable. This is the Cash Flow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cash Flow Show. Discuss topics like getting paid on time, profitability, and managing your bottom line, payroll best practices, the best apps to use, and cash flow forecasting tools. So if you're a small business owner, your help's right around the corner. Fret not. Tune in as Scott and Nikole help you reach your goals on the Cash Flow Show. The Cash Flow Show, where we help the small business gain momentum and become profitable. This is the Cash Flow Show. Listen and learn. We'll show you how to pay yourself on what your business earns. Cash Flow Show. Our advice will take you far. Cash Flow Show. Tune in with Nikole and OKR.